Get to the brass tacks already. Tell me something. I've sat here and listened to this shit for a little while. Give me something to go home with. Okay. When you're in drawdown and you really simply just got to have the fucking trade that you can trust, that silver bullet trade that you want, where does it happen? Where does it form? And also, how can I use this even when I'm not in drawdown, where it forms consistently? Where does it form, ICT? Come on, spill the beans, man. All this build up, all this bullshit, spill it. That's my cards. See that? I'm such a dick. Between 10 o'clock and 11 o'clock in the morning, New York local time, you will find a fair value gap that will deliver 5 handles every fucking day. Guaranteed, absolutely fucking guaranteed. It's never going to be a day, even on a shit show day like on Friday. It will always, always be there, aiming for an opposing pool of liquidity, sell side or buy side. In my head, when I'm waking up, sometimes my wife prevents me from getting in front of the charts right at 9:30. Now, she's understanding because I've been mentoring you. The days I tell you I'm going to live stream, she graciously gives me that time to be here when I'm here with you. But sometimes we may be in bed longer in the morning because we stayed up later, or we may do something because of homeschooling with our kids, or something with the dogs. Something prevents me of being there at the 9:30 opening. I know as long as I get to my charts by 10 o'clock and I can stay there till 11 o'clock, I can take something out every fucking day. Every day, even on days that have the shortened holiday schedule, when they close it like at noon. Don't believe me. Don't take my fucking word for it, folks. Don't believe anything I just said to you, because I want you to go into your charts and you'll see it's always there. Absolutely. Guaranteed. 100%. It's always there. There's your silver bullet. There's your pass your funded account bullshit. There's your fucking win the Robbins Cup model. There's everything you're looking for. Between 10 o'clock and 11 o'clock, it happens every day. 1 minute, 30 second, 15 second. There's your 3 time frames. It will form in one of those 3 time frames. All you have to do is wait for the obvious run on liquidity. Is it going for buy side or sell side? And if as long as it's giving you at least a range of 6 handles or more, you'll get your 5. What does that mean? As long as that fair value gap forms on a 15-second, 30-second, or 1 minute chart, and you know where it's reaching for, it can be late in the move. I don't give a fuck. That's not chasing to me, because a fair value gap, guess what that is? It's in the middle. That's where the meat is on the bone, baby. See, you're looking at charts thinking you have to have that end joint, high part of the bone or the low part of the bone. Precision is not limited to that. When you look at a chicken leg, okay, where's all the meat at? It's not on the ends. It's in the middle. It's in the middle. It's in the bulk end of one of those ends of the leg, but to the middle of the bone. And you get down to the opposite end, it's thinner. It's not a lot of meat down there. It's just a tendon down there. Nobody likes to eat that. A fair value gap is how you enter a trade that's in motion. Technically, to the uninitiated, the people that don't know how to read price outside of our circle, they look at what we do as, oh, it looks like chasing price. ICT, you did a revenge trade. Get the fuck out of here. You have no idea what you're talking about. You have no idea what I'm doing to get in those trades. None. You're learning this year, but it's not chasing price. If I know that this is going to run for liquidity and it's already moved and I missed the best case entry, and we've already had a fair value gap that it's repriced down into, it's not going back down if I'm bullish. It's already done what's required. Then I'm going to drop into 1 minute, 30-second, 15-second, and I'm going to look for a fair value gap. And the next one that forms, I'm in that bitch. Boom, take off. Get my 5 handles or even more, whatever the difference is between where that fair value gap is forming to the liquidity I'm aiming for. And I submit to that. I let it go. And then the algorithm sends it. And then I go on social media and say, wow, how random. Start with this easy stuff, knowing where the market's likely to go, knowing that wherever the market is right now, or where it recently came from a low, if it's bullish and you think it's going to go up 100 handles on S&P, then you take a fib and you extend it from the low it just recently made that you don't have to necessarily be in along from. Or if you're lucky enough to know what you're looking for and you were in front of the charts as it happened and you bought that low, then you take your fib and you extend it up and you look for 25, 50, 75, and terminus. Terminus is the draw on liquidity, where it goes to. Inception of the move is the low in this case. So you're looking for these areas where what's going to form? Fair value gaps, order blocks, stop runs. They're going to occur at the 25, the 50, and 50 is going to consolidate because it's equilibrium. Look at what I showed you last night and think about what I taught in month 1 content of the core content, where I talk about the 4 stages of how markets deliver price. The algorithm does 4 major things. When does it consolidate, ICT? I just went through answering questions on my forum. I'm not going to give you those answers here, but I'm giving you clues in knowing how to know where consolidations occur. Consolidations in intraday price action will occur around equilibrium. What's equilibrium? The 50% of that SIBI. It doesn't have to go up there and completely close in that one big drop. It doesn't have to do that. That's where Chris Laurie's group and I differ. They like to see all that stuff. I know what I'm looking for. I know when it ain't going to fill. I know when it's only going to go in there a little bit, and that's an institutional order flow entry drill. I prove it because that's how I do my pyramid entries in. You don't get that anywhere else. Okay, I'm not trying to kick sand in his face or anything, but I'm just reminding folks who's who and who you're listening to. It's just confidence in authorship. It's not arrogance. It sounds like it, but it's not. But having that graded price run, it allows you to plan. It allows you to expect and anticipate new entry patterns. Main takeaway is we were waiting for the 10 o'clock hour. This is that silver bullet that I was giving you in that Twitter space. Some of the newer folks are like, what'd you say? Silver bullet? What's that? Silver bullet trade, ICT, is a setup that will form every single day. Every single day it will form. And what you're looking for is between 10 o'clock New York local time and 11 o'clock New York local time. There will be a displacement in a direction that you should be anticipating. Once that displacement occurs, you're waiting for a fair value gap to form. When it does, you're going to be expecting that to be traded into and then repriced to a pool of liquidity that would be opposing your entry. For instance, what we're outlining here. We've already seen, a small minor delivery of it. I mean, it's been 5 handles or so since that run in here. But the expectation is for you to anticipate this formation in price every trading day. Every single trading day it will form, which is why I call it silver bullet. It's a move that will always be there. They will never be able to hide it from you. They're never going to be able to change it. Nothing's going to change it. It's always going to be there. There's never any reason for you to doubt that it won't exist. Okay. And it's also a way to train yourself patience, teaching yourself patience, sticking to a model and some rule-based ideas. And those being, you're looking for 5 handles. That's it. As a new student, as someone that's just now starting to become interested in the marketplace, it's a little intimidating, isn't it? Who do you listen to? Who do you trust? What do you waste your time on in the beginning and regret later on? And you want to avoid that. You want to go to the people that have the best stuff.
You're thinking that there's a system or a teacher out there that's going to teach you how to never lose. They don't exist. I'm not that guy. So there's a lot of things that go through your mind when you first get involved in all this stuff. So I try to be as responsible as I can and say things like, you're going to practice in a demo. You're not going to trade with live funds. You're going to decide if you ever decide to do that. I don't ever tell you to do that. But I promise that you're going to see things in price that are very consistent. They're rule-based, structured approaches for you to go in and study like a laboratory experiment. If I was to say to you, go out there and find some random fair value gap and pick a sell side or buy side liquidity pool, and good luck at it. Right away, 90% of you are going to be like, what am I supposed to do with that? This guy's not teaching me anything. Versus, okay, if I tell you, you hear my stomach, I'm starving. 2 days fasted. So if we are looking at a time window, very specific time window, 60 minutes, okay? Inside of 1 hour, you can find a 5-handle run that's reasonably easy, in my opinion. And of course, my opinion is biased because I've been doing it a lot longer than you. But out of all the things that I teach, I think that it's visually easy to see a fair value gap. It's easy to see that. But it may not be easy for you right now. But it's easier to see that than a breaker. It's easier, way easier, to see it than determining what order block to trade off of. There's a graduation between one PD array and understanding it to the next, but you only need one. And if you remember, I set that 2022 model up with my daughter in mind. Like, I wanted to see her use that model, and I didn't want to see any excuse for her to say, well, I can't see it because the fair value gap jumps off. It's literally there in the chart, and even someone with a short span of attention, if I spent time with them going through charts and showing it to them, they could see it, and they could go into the charts and find it in hindsight. But they don't have the experience to see it forming real time. And that's what these live sessions, and that's what the Twitter experience with me is helping with. It does not remove the necessity for you to be looking and studying, not just on those instances where I'm taking your attention to, but other old moves, and studying that and seeing it repeat over and over again. My stomach is talking. But the silver bullet is a time-specific setup that forms between 10 o'clock and 11 o'clock. And I know you're already going to ask, why does it only work in 10 and 11 o'clock? Well, that's the morning session, silver bullet. There's an afternoon session that I'll teach you later on. You got all year, okay, all kinds of tricks to show you. But between 10 o'clock and 11 o'clock, what you're looking at is the last portion of the move that's going to unfold just for that AM session. And you're right in the heart of that move. And fair value gaps are generally forming after a move begins. There's an inception of a move that you missed. That's like selling short above old highs. You didn't get in it. You weren't able to do that, but you don't need that. Like I was teaching with the 2022 model, you don't need that to be able to do consistent setups. Between 10 o'clock and 11 o'clock, you are in the heart of the AM session move, which is essentially between 8:30 in the morning to 11 o'clock. It can go as far as noon, the beginning of New York lunch hour, but it's, again, a graduated thing in terms of time. There are macros that exist in price where between 9:50 and 10:10, in that 20-minute period, generally you're going to see a price run that begins within that 20-minute span. There's people out there trying to teach my stuff already in their little mentorships or their thing in Discords and such, Instagram. And they're already trying to say the move happens between 9:50 and 10:10. You're already doing it wrong, so stop trying to teach my stuff. The move begins in those 20 minutes. It's not the entirety of, I mean, obviously it can, in a fast move or fast market, it can do that. But what you're looking for is a run that begins between 9:50 and 10:10. That's the macro. It starts doing its run between those two time windows. There's another macro that exists at 10:50 and 11:10. There's two macros that start in those two hours. The silver bullet is specific to the 10 o'clock to 11 o'clock hour. And what we're looking for is an obvious pool of liquidity that has not been tapped into or engaged, which I've mentioned, obviously, with the lines here, you see it. You're not demanding that you capture the daily range. You're not demanding that it goes to your technical target. You're only expecting it to give you your 5 handles. Big paradigm shift there, because a lot of you also are taking this idea and trying to make more of it than it really is. Will there be times when that move is a significant higher low of the day and it just keeps on running? Yes. But in the beginning, you don't know when those are going to be there. You don't know what that criteria is to cause that. That's a whole lot of other things that you have to learn progressively over time. So I'm reminding you as gently as I can to stick to the rules I'm telling you to stick to. And that way you won't be taken into these false expectations that it's going to do much more than it's designed to do. Case in point, fair value gap, I told you that we extend that forward. When it was bumping up on the bottom of that, here I was looking at the 5-minute chart. I thought it was a 1-minute chart because I was busy talking to you. I said I would go short there with the expectation to run lower. If you see that price there at 78 3/4, that's better than 5 handles. Did it take the sell side? No, but that's the structure that we used for draw and liquidity. Remember, I teach partials. I teach that you have to pay yourself. I teach you that it's just a way for you to frame your expectations on where the price should gravitate to. So go back up to a 5-minute chart real quick. So here's the low I was anticipating a draw to. Fair value gap here on the 5-minute chart as it went up into there. So as we hit that, if it were not seeing these relative equal lows here, if we didn't have the relative equal lows, if it was just one singular low, that would be an aggressive entry for me, and it would be where I told you. And it delivered immediately, as I said it, attacking this short-term low. It offered more than 5 handles. That would be it. Now, compare and contrast, I know some of you probably already in this trade, and you were probably holding on for this sell side, and this probably just ripped against you. Don't take the trades. You're learning how to read a tape. Everything I just explained to you has not been explained anywhere else about this type of setup between 10 o'clock and 11 o'clock. You didn't have that insight before you pushed the button. You had no idea what you're doing. You're impulsively trying to do something based on what I'm saying real time, instead of learning the lessons from watching and listening to what I'm expecting, what rules are there, what parameters are there. You can't learn doing what you're doing by pushing a button. You can't do that. You have to learn it and then go practice with it. Go look for it in old moves. That's the order of things. You don't learn how to do it by listening to me and trying to do it as I talk about it. That's not how you learn. So anyway, the delivery of 5 handles, that's the easy, absolute, 100% guaranteed time-specific setup that if you are a brand new person or someone that's coming to this channel for the first time, a setup that forms so consistently, so routinely, there's so many things that are inside this model, and it's a complete model. It's an entire model in and of itself. Think about what it's offering. You don't have a whole lot of time? Okay, no problem. You want to do this while you have your day job? Does your job permit you to have a lunch hour early in the day between 10 o'clock and 11 o'clock? Because if so, I would take my lunch then. That way you're not stealing time from your employer. You're being a good steward. And your time won't be divided, or your attention won't be divided during that time, because you'll be expected to do what you're being paid to do by your boss instead of watching candles form on your charts. If you are looking for a way to not spend so much time in front of the charts, which I can tell you is a good thing because it's fatiguing over time. I don't care how much money you make, it's still very fatiguing to do it. It will wear on your eyes, it will wear on your back, it will wear on your body and your stress. So you want to kind of keep it to an optimal level. And I can't find a way to be more optimal than a 1 hour trading workday. Between 10 o'clock and 11 o'clock, you absolutely know that this formation is going to be there. It's going to be there. Now, does that mean that you're going to have a winning trade every single day between 10 and 11 o'clock? Absolutely not. Absolutely not. It just means that you have an opportunity to have something that statistically is there all the time. And I don't want you to take my word at this. I want you to go back and look at every single trading day you can have data on and go through and see it's there. Now, what you need to practice is understanding, as I mapped out this morning, you don't need to be right about your levels. You just need to be right about, does it offer the range? Does it offer something better than 5 handles? Because if it can move better than 5 handles, chances are you probably will get 5 handles out of it. What do I mean by that? When we were looking at this fair value gap here, and it was bumping up and against it here, I said, okay, if we didn't have the relative equal lows here being specifically this low and that low, what was my apprehension? Because this could be a run lower, take the sell side out, and then rip higher and complete that new week opening gap high here. So it's not a singular low, it's relative equal lows. So there's going to be sell side below that. So they went down below it, yes, but I wanted to see this low taken out. That was one I would have been preferring rather. But an aggressive entry would have been right here. Did it offer 5 handles? Sure. Did it get to the sell side? No. Does it mean rather the model's broken? No. You're operating inside these rules with the expectation that it's going to offer you 5 handles. You might not get it. It might be an instance where you're watching price and you expected to do something like I would, what I was looking for, and it might not deliver it to you because your parameter, your entry, your limit order didn't get tagged in. You can't look at that as a reason to be upset. You can't be thinking, well, I wasted my time. How many 10 o'clock to 11 o'clocks in the future are going to be available to you? As long as you have breath, right? As long as you have your mental faculties and the markets are open, you have lots of those laboratory experiments to work with now. Will it take you 2 years to grow confident in using this as a model? I don't think so. But I think about 2 to 3 months is realistic because you want to see previous data to confirm what I'm suggesting to you is valid. Then, when you see all that, then you'll feel comfortable with investing the time of walking forward with it, tape reading it. And you do that for several months. That way, when you're bored of it, and you see it, you're not emotional about it, not nervous, not excited because it moved in your favor. You're just completely indifferent to the outcome. That means you're bored. That is the only time that if a trader thinks like that, then they can entertain the idea of maybe putting real money at work. But that's a decision that you determine that. And when is it going to be where you're bored? It's all completely objective from your perspective only. And it would be foolish of me or anyone else trying to be a mentor or a teacher to say you're ready when this and this. No. The only defining determination is you know that you're not emotionally stimulated by the outcome. You're not chasing a feel-good moment. You're not trying to replace a bad experience with a good win. And you're just following the rules. And that's a very hard thing for you to understand, especially if you're new, because you don't even have any rules. You don't have any experience. You haven't seen this form in previous data enough times to know that what I've said it exists every day. Between 10 o'clock and 11 o'clock, identify liquidity, find a fair value gap, The fair value gap has to be opposing, in other words, opposite to the direction that you anticipate the liquidity to be drawn to. For instance, fair value gap after displacement lower, we wait for it to trade up into the fair value gap and then trade towards a pool of liquidity lower in the form of sell side. If you're bullish, you're looking for the market to trade higher, displacement higher, leave a fair value gap below market price, then trade down to the fair value gap, and then gravitate towards a pool of liquidity, which would be buy side that hasn't been engaged yet. And it has to have better than 5 handles in terms of the range from where you think it might get to. Not that it needs to get there. Remember, I'm teaching you how to look at price, removing the necessity of being right. Because right is not, it's not a destination. Being correct is not a destination. Excellence in execution is, and it has a very small population. The only way you get to be a member of that is by doing the things I'm telling you to do and avoid the things I'm telling you to avoid.
The last thing, obviously, is market making principles. So market making principles are simply like time of day. When is there an intraday influence? When do things that normally occur, like market protraction, like Judas swings? Let's go back to understanding the market structure and the shifts quarterly. Okay. If you are looking for a way to systematically reduce everything down to a nuts and bolts, this is how I do things, this is how I follow this process, I'm not going to do anything outside of these rule-based ideas, this is what you are trying to do. You want to do this with your trading plan. Between April, May, down into June, you really want to be focusing on going short stock indices. The bigger moves, the cleaner moves are going to be on the sell side. Going long in the fall, going into they call it the Santa Claus rally, the Christmas rally. The market tends to create a little bit of a flurry run up higher going into the close of December. Now, with all the things going on in the world today, that's probably an invitation for it to not pan out this year. And if it does, don't let it be discouragement, because I want you to go back through as many years as you got data to go back and look at it, and you'll see it's there. It's there, it repeats, it repeats, it repeats. Okay. So doesn't it make sense for you to be focusing on one side of the marketplace where there's the tendency for it to move in greater magnitude, one direction, and lean only in that direction for your bias and narrative ideas for taking trades? Right away, you have filtered 80% of the bullshit that most traders fall victim to. You're not going to push it hard in the summertime because it's the doldrums. Now, there's opportunities to do that, but you're not going to be pushing your highest leverage. You don't want to do that because there's a likelihood of it becoming choppy and messy. So time of day, you want to be focusing on, if you're, say you're in the sell model, in the spring highs that go down to the summer doldrum lows, leading into the fall months low that starts to rally up into the close of the year. During the spring fall time period, I shouldn't say it like that. In the spring declining or sell model, where it's likely to go lower on the daily chart and continuously drop lower, if you look at time of day, you can start studying and see that the London Open between 2 o'clock and 4 o'clock in the morning Eastern Standard Time, you will have a 70% likelihood of seeing the high of the day form. What will it look like? It will look just like that fucking model I gave for free on YouTube. You're going to wait for some buy-side liquidity to be taken. Then there's a shift in market structure. Wait for the fair value gap to form. Sell short in the fair value gap. Hold it. Minimum. Hold it minimum to New York Open. And then see if New York gives you a continuation where you can go in and maybe pyramid. That's a goal for you to do. Not go out there and start doing it right now. It's just something you grow into. That's where you have to have a model right now you work on. But what is your end objective? What are you really trying to do as a trader? I want to sell short the highs in the London session, or buy long the lows in the London session and hold for the daily range. That's day trading. If you're doing anything less than holding for the daily range, you are intraday scalping. That's it. Now you can break that down into session swing trading, where you're swinging the entire New York session or the London session and getting out before 5 o'clock in the morning Eastern time. There's nothing wrong with that if that's your model, if that's what you want to do. And you don't want to do anything else because time of day and schedule, school,